At this moment, inside a small working group housed within one of the multilateral surveillance agencies, there exists a project that does not appear on any public agenda. Its internal designation is dry and technical: Comprehensive Liability Assessment Framework, Excluded Categories. The premise is simple. Official government debt figures published by national statistical offices and used by credit rating agencies capture only a narrow slice of the obligations that governments ultimately stand behind. The working group's task is to identify, quantify, and model the categories that are systematically excluded from headline debt statistics, and to estimate what sovereign balance sheets would look like if those exclusions were corrected. The first draft of their findings was circulated 6 months ago. It did not result in any public statement. It resulted in a series of closed consultations with debt management offices in several capitals, none of which were reported in the press. The document opens with a taxonomy. It divides government obligations into 4 quadrants. The first quadrant is explicit and direct: bonds, loans, and bills issued by the central government and recorded on the national balance sheet. This is the number that appears in every official debt report. The second quadrant is explicit but contingent: guarantees on loans to public enterprises, deposit insurance schemes, credit lines extended to subnational governments, and commitments under public-private partnership contracts. These obligations are recognized in legal documents, but they do not appear in debt statistics unless and until they are triggered. The third quadrant is implicit but direct: unfunded liabilities in pension and healthcare systems, where benefits have been promised but not backed by dedicated assets. The fourth quadrant is implicit and contingent: the expectation that governments will bail out systemically important banks, support failing industries, or absorb losses from state-owned enterprises even when no formal guarantee exists. The working group's analysis covered all 4 quadrants. Official debt statistics cover only the first. The investigation began with a routine question raised during a sovereign debt sustainability review. An analyst noticed that 2 countries with similar official debt to gross domestic product ratios had vastly different market spreads. One was priced as nearly risk-free. The other faced elevated borrowing costs. When the analyst dug into the details, the divergence made sense. The country with higher spreads had a large banking sector backed by implicit government guarantees, a generous public pension system with minimal funding, and a history of bailing out state enterprises. The country with lower spreads had a smaller banking sector, a partially funded pension system, and stricter rules on enterprise support. The difference was not visible in the headline debt number. It was visible in the contingent and implicit obligations that sat outside the official accounts. That observation led to a broader project: systematically reconstruct the balance sheets of a sample of advanced and emerging economies, adding back everything that had been excluded. To understand why these exclusions matter, it helps to review how sovereign debt accounting is supposed to function. Under international standards, a government liability is recorded when it is certain, legally binding, and quantifiable. A bond issued today meets all 3 criteria. A guarantee on a loan to a public company does not, because the liability only materializes if the company defaults. An unfunded pension promise is trickier. The obligation is real and legally enforceable, but it is spread over decades and depends on future demographic and economic variables. By convention, such promises are disclosed in footnotes or annexes, but not consolidated into the main debt figure. The rationale is that including uncertain future obligations would make debt numbers volatile and hard to compare across countries. The cost of this convention is that the headline number can be deeply misleading. The working group developed a methodology to bring these excluded categories into the main picture. For explicit contingent liabilities, they gathered data on outstanding guarantees from budget documents, central bank reports, and filings by public development banks. They calculated the probability-weighted expected cost of these guarantees based on historical default rates and current credit conditions. For implicit direct liabilities, they used actuarial models to estimate the present value of unfunded pension and health commitments, adjusting for projected changes in life expectancy, workforce participation, and benefit indexation rules. For implicit contingent liabilities, they estimated the potential fiscal cost of bank recapitalizations and enterprise bailouts by modeling stress scenarios and applying historical loss rates from past crises. Each category required assumptions, but the assumptions were transparent and could be tested. When the results were compiled, the picture changed sharply. For the sample of 20 advanced economies, the median official debt to GDP ratio was around 90%. When explicit contingent liabilities were added, the median rose to 110%. When unfunded pension liabilities were included, it jumped to 240%. When implicit guarantees to the financial sector were factored in, the total reached 270% in the median case, with some countries exceeding 350%. The distribution was wide. Countries with smaller banking sectors, funded pension systems, and strict bailout rules stayed below 200%. Countries with large state-owned banking systems, generous pay-as-you-go pensions, and histories of intervention crossed 300%. The working group noted that these figures were not predictions of imminent default. They were measures of the gap between promises made and resources set aside to honor those promises. The report then examined each excluded category in detail. Guarantees to the banking sector were the largest single item for many countries. These guarantees are rarely explicit in normal times, but they become explicit during crises. When a major bank faces insolvency, governments almost always intervene, either through direct capital injections, asset purchases, or liquidity support. The fiscal cost of such interventions can be enormous. Historical episodes show costs ranging from 5% to over 40% of GDP, depending on the size of the banking sector and the depth of the crisis. Regulators require banks to hold capital buffers, but those buffers are designed to absorb losses under normal stress, not systemic shocks. When systemic shocks occur, the government steps in. The market knows this. It prices bank liabilities assuming implicit state backing. That implicit backing is a hidden subsidy to the banking sector and a hidden liability for the government. Unfunded pension liabilities represent a different kind of exclusion. Unlike guarantees, which may or may not materialize, pension obligations are certain. Workers have contributed. Benefits have been promised. The law protects those promises. The problem is that most public pension systems operate on a pay-as-you-go basis. Current workers' contributions fund current retirees. There is no pool of assets backing future claims. As populations age, the ratio of contributors to beneficiaries falls. At some point, contributions no longer cover benefits, and the gap must be filled from general revenues. That gap is a fiscal obligation as real as any bond, yet it does not appear in official debt statistics. When researchers calculate the present value of these unfunded promises, the numbers are staggering. For some countries, unfunded pension liabilities exceed 150% of GDP. Adding them to the official debt stock transforms the fiscal picture. State-owned enterprises and subnational governments form another layer of hidden risk. Many governments own or control enterprises in sectors such as energy, transport, and finance. These enterprises issue debt under their own names. If they operate profitably and service their obligations, the fiscal impact is neutral. But when they face losses or liquidity crises, governments often step in. The intervention may be framed as a loan, a capital injection, or an asset purchase. In substance, it is a transfer from taxpayers to creditors. The same logic applies to subnational governments. In federal systems, regional or local authorities borrow independently. Legally, the central government may not be responsible for their debts. In practice, political and economic pressures often force the center to provide support. Rating agencies and investors understand this dynamic. They price subnational debt assuming some degree of central government backing. That backing is not recorded as a central government liability until it is activated, but the expectation exists in the market. The working group also highlighted a structural issue: the interaction between different categories of hidden liabilities. A banking crisis can trigger guarantees, forcing the government to borrow more. Higher government debt raises sovereign risk, which in turn weakens banks that hold government bonds. This feedback loop, sometimes called the sovereign bank nexus, amplifies the fiscal cost of contingent liabilities. Similarly, an aging population increases pension costs, which puts pressure on the budget, which may lead to cuts in other areas or higher taxes, which can slow growth and make debt dynamics worse. The categories are not independent. They are interconnected, and stress in one area can cascade into others. Standard debt sustainability analysis treats government liabilities in isolation. The comprehensive assessment revealed that the whole is larger and more fragile than the sum of its parts. After establishing the scale of excluded liabilities, the document turned to a harder question. Why do governments and international institutions tolerate such large gaps between reported and actual obligations? The working group identified several reasons. The first is political. Including contingent and unfunded liabilities in headline debt figures would make fiscal positions look worse, which could undermine market confidence and increase borrowing costs. Politicians prefer to present favorable numbers. Excluding uncertain obligations allows them to do that. The second reason is technical. Measuring contingent liabilities requires assumptions about probabilities and timing. Different assumptions produce different numbers. There is no single correct figure, which makes it difficult to standardize reporting. The third reason is institutional inertia. Debt accounting conventions were established decades ago, before financial systems became so large and interconnected, and before pension promises accumulated to current levels. Changing those conventions requires international coordination and political will, both of which are scarce. The report noted that some progress has been made. A number of countries now publish statements of fiscal risks alongside their budgets, disclosing major contingent liabilities and long-term spending pressures. International standards encourage such disclosure, but disclosure is not the same as consolidation. The information exists in annexes and supplementary documents. It does not feed into the headline debt number that markets, rating agencies, and policymakers use for decision-making. As a result, the incentive structure remains distorted. Governments can take on large contingent liabilities without immediate fiscal consequences, because those liabilities do not show up in the main accounts until they materialize. By that time, the political actors who created them may no longer be in office. The working group tested whether markets price these hidden liabilities even if official statistics do not. They ran regressions comparing sovereign bond spreads to both official debt ratios and augmented ratios that included contingent and unfunded obligations. The results were mixed. For emerging markets, spreads correlated strongly with augmented debt measures. Investors appeared to be pricing in the off-balance sheet risks. For advanced economies, the relationship was weaker. Spreads stayed low even for countries with large hidden liabilities, as long as those countries had reserve currency status or strong institutional frameworks. This suggested that markets were either not fully pricing the risks, or were assuming that advanced economies had greater capacity to manage or delay the recognition of those risks. Either way, the feedback mechanism that is supposed to discipline fiscal policy was not working as intended. One section of the document focused on the fiscal cost of past episodes in which contingent liabilities materialized. The working group compiled a database of 200 such episodes over the past 30 years. On average, when guarantees were called or implicit support was provided, the fiscal cost was 6% of GDP. But the distribution was wide. In some cases, costs were less than 1%. In others, they exceeded 20%. The largest costs occurred when banking crises, pension shortfalls, and enterprise failures hit simultaneously. The report emphasized that these were not hypothetical risks. They were realized losses that had already occurred in numerous countries. The fact that they did not appear in debt statistics before they materialized did not make them any less real. It simply meant that the warning signs were hidden from view until it was too late to take preventive action. The analysis also addressed the question of sustainability. A government's ability to service its debt depends on its revenue base, its growth prospects, and the interest rate it pays. Standard sustainability models project these variables forward and ask whether the debt ratio stabilizes or explodes. The working group ran these models using both official debt figures and comprehensive liability estimates. Under official figures, most advanced economies appeared sustainable, albeit with limited fiscal space. Under comprehensive figures, several crossed into the zone where sustainability required either very optimistic growth assumptions or very low interest rates sustained indefinitely. In scenarios where growth disappointed or rates normalized, the debt dynamics became unstable. The government would face a choice: restructure obligations, monetize debt through inflation, or implement severe austerity. All three options had been used historically. None were painless. The document explored the legal and political challenges of addressing unfunded liabilities. Pension promises in particular are often constitutionally protected or embedded in contracts that cannot be easily changed. Attempts to reduce benefits or raise retirement ages trigger legal challenges and political resistance. Yet the math is unforgiving. If the present value of promised benefits exceeds the present value of expected contributions and investment returns, someone must bear the shortfall. It can be current workers through higher taxes, future retirees through lower benefits, or the general public through inflation and reduced public services. The choice is distributional, not technical. The report noted that delays in making this choice do not eliminate the problem. They simply shift the burden toward those with less political power to resist, often younger generations and future taxpayers who are not yet represented in the political process. Another section examined the role of international institutions. Organizations such as the International Monetary Fund and the World Bank have long advocated for better disclosure of fiscal risks. They publish guidelines, conduct assessments, and provide technical assistance to help countries identify and manage contingent liabilities. But their influence is limited. Countries are sovereign. They cannot be forced to adopt accounting standards or include certain items in their debt figures. The working group suggested that international pressure could be more effective if rating agencies and investors systematically incorporated comprehensive liability measures into their assessments. If markets began to price the full balance sheet rather than just the official debt number, governments would face stronger incentives to reduce hidden risks. So far, that shift has been partial at best. The report concluded with a scenario exercise. It modeled what would happen if a major advanced economy experienced a banking crisis, a pension funding shortfall, and a downturn simultaneously. The combined fiscal cost, based on historical averages, would be around 15% of GDP. If the country's official debt was already at 100% of GDP, the shock would push it to 115% in the official accounts. But if contingent and unfunded liabilities were included, the starting point would be closer to 250%, and the shock would take it to 265%. At that level, market access could be lost. Yields would spike. The government would face a financing crisis. The scenario was not a prediction. It was an illustration of how hidden liabilities can transform a manageable shock into a systemic event. The final paragraph returned to the central point. Official debt statistics serve a purpose. They provide a standardized, comparable measure that can be tracked over time. But they were designed for a different era, when governments were smaller, financial sectors were less complex, and pension systems were not facing demographic cliffs. In the current environment, relying on those statistics alone is like navigating with a map that omits major terrain features. The features are still there. Ignoring them does not make them disappear. It just means that when the terrain asserts itself, the shock will be larger and the options fewer. The question left for readers of the document was not whether comprehensive liability assessment should replace official debt figures, but whether decision makers and markets are prepared to act on the full picture, or whether they will continue to navigate by incomplete maps until the excluded liabilities materialize and force recognition in a single disruptive event.